In today's episode, I'll talk about two interesting stories. In the first story of the day, I'll talk about one of the largest trading education scams that SEBI has uncovered in the last few years. And in the second story of the day, I'll talk about why the RBI recently cut repo rates for the first time in 5 years. Welcome to the Daily Brief show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for you to understand, yet one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Monday, the 10th of February. Let's start with the first story of the day. See, recently, India's financial market regulator, the SEBI, uncovered what's possibly one of the largest trading education scams in recent years. Now, at the center of this entire story is this company called Ashmita Patel Global School of Trading Private Limited and also its founder, Ashmita Patel. But to understand what really made this case so significant, let's first understand who Ashmita Patel exactly is. See, she has built herself into a major social media influencer in the financial world. She has an impressive following of more than 500,000 subscribers on YouTube and nearly about 300,000 followers on Instagram. Now, she presented herself as a trading expert and claimed to have taught more than 100,000 students worldwide about how to make money in the stock markets. Now, this company offered various trading courses. Their main program was called Masters in Price Trading Action. And mind you, this was not at all cheap. The entire course cost about 7 lakh rupees plus 18% GST, which came up to 8.2 lakh rupees. And apart from that, they also offered other courses like Let's Make India Trade and Options Multiplier. But what caught SEBI's attention were the extraordinary claims that were being made here. The company told potential students that they could expect returns of 35 to 40% from trading. They also shared impressive success stories. A chartered accountant who supposedly turned 30 lakh rupees into 12 crore rupees in just 18 months. And even an 18-year-old who reportedly made more than 12 lakh rupees in less than 1 year. They even had claims of making 12% monthly profit without watching the market altogether. And in some sessions, they went as far as showing calculations suggesting 30% returns were possible. But obviously, SEBI's investigation here revealed a very stark contrast between these claims and the reality. Now, while the company was boasting about managing 283 crore rupees through their proprietary trading system, their actual trading activity showed a turnover of only 15.27 crores with a modest profit of 12.28 lakhs. Now, this massive disparity raised some serious red flag for the investigators. And if you think about it, the entire company's operations were very carefully structured. They would first attract people through a 3-day course, and during these sessions, they would encourage participants to take drastic financial steps, suggesting they sell their mutual funds, liquidate their gold, and even borrow money from friends and family in order to join more expensive courses. They would then start downplaying the risks of trading, suggesting that it was safer than running a restaurant. Now, after students enrolled into their main course, they were required to open trading accounts with a specific company where Ashmita Patel was an authorized person. Students were then added to exclusive Telegram channels called M16 and M17 Technical Update. These channels were not just for education, obviously. They provided specific trading advice, including exact entry prices, stop losses, and precise timing for trades as well. And whenever these trades went wrong, they would immediately provide new trading parameters altogether. And in order to safeguard themselves from trouble, the company also took some steps to prevent students from communicating with each other. During online sessions, participants were muted and they could not at all interact with each other. Questions on the chat portal also were often unanswered. And this isolation meant that students couldn't share their experience or collectively raise concerns about the program at all. And to tell you about the financial state of the operation, it was enormous. Between 2019 and 2024, they collected over 90.49 crore rupees in fees through their main company alone. And when SEBI included fees that they collected through 3 other related entities, King Traders, Gemini Enterprise, and United Enterprise, the total exceeded 104 crore rupees. So in response to these findings, SEBI has now taken some very strong actions. They have ordered the company to stop offering unauthorized investment advisory services, they have frozen their assets, and are also working to recover 53.67 crore rupees that they describe as ill-gotten gains. Now, this case has also been referred to tax authorities for potential GST and income tax violations. So in many ways, this case serves as a very powerful reminder to people like you and me on how social media influence can be used to promote questionable financial schemes. It also shows why we should be very skeptical of anyone who's promising guaranteed returns or is claiming to have a perfect system for making money in the stock market. Also, the specific combination of social media reach, persuasive marketing, and financial promises can be really dangerous. And it especially targets those people who are eager to learn trading and investing and also earn quick money. With that, let's move on to the second story of the day. Recently, India's central bank, the RBI, made a very significant announcement. They decided to reduce the policy repo rate after 5 long years. Now, for your quick reference, this is essentially the interest rate at which the RBI lends money to other banks in India. They lowered this rate by 0.25 percentage points or 25 basis points in financial terms and brought it down to 6.25%. Now see, whenever the RBI or for that matter any central bank changes this key interest rate number, it affects everything from how much it costs businesses to borrow money to how much interest you might earn on your savings account. And what makes this decision particularly noteworthy here is that all the members of the RBI's decision-making committee agreed on this move unanimously. Now this shows strong unity in their thinking as well, which is a positive sign. And this is especially interesting because central banks in other countries are still being very careful about lowering their interest rates. So the question here is, why exactly is RBI making this decision? See, the main reason here is that India's economy is not really growing as fast as it used to. In the second quarter of the current financial year, the economy's growth rate slowed down considerably to 5.4%, which is quite a drop from the impressive 8.1% growth that we had seen in the same period last year. Now, this slowdown, mind you, is not just a temporary hiccup. Several important parts of the economy are starting to show some signs of strain. Businesses are not really investing as much money as they used to do earlier, and people in cities who typically drive a lot of spending activity in the economy are now being more careful with their money. Now, when the RBI looked at how companies performed in the most recent quarter, they saw only slight improvements, which suggests that these challenges are not really going away anytime soon. So looking ahead to the next financial year, which is FY 2026, the RBI is expecting the economy to grow by about 6.7%. And while this may sound like a great number when compared to global standards, it is actually lower than what the Indian economy is actually capable of achieving under ideal conditions right now. They are predicting slightly better growth of around 6.9% in the first half of the year, slowing down to about 6.5% in the second half. Now, one of the most interesting things here is how differently the RBI and the general public are viewing inflation right now. The RBI thinks that inflation will come down to 4.2% in the next financial year. But when regular households were surveyed, they expected prices to rise more rapidly by around 9.3% in next 3 months and even higher at 10.2% over the next year or so. And this difference in expectations is very important because what people think about future prices really affects how they spend and save their money today. Also, a bit of a deeper look at inflation shows us some very interesting patterns as well. If you remove the effect of vegetable prices, which are usually very volatile, the underlying inflation rate is actually quite stable at around 3.9%. But there are still some concerns on the horizon. The prices of cooking oils are under pressure, and increasingly extreme weather events due to climate change, etc., could really affect food prices in many unexpected ways. India's relationship with the global economy also adds another layer to this story. See, since October, foreign investors have taken out about 21 billion US dollars from the Indian markets, which has caused the Indian rupee to lose some of its value against the US dollar. But there is good news as well. India has strong fundamental supports here. Our country has enough foreign currency reserves of upwards of 600 billion US dollars, which is enough to pay for more than 10 months of our imports. We also continue to receive the highest amount of money sent home by Indians working abroad, which is also called remittances, which total about 129 billion US dollars. Now, looking forward, many experts are of the opinion that the RBI might reduce interest rates by another 0.25 to 0.5 percentage points in the upcoming financial year. But they will still be watching economic growth and inflation very, very closely to decide when and how quickly to make these changes. The RBI is basically trying to be flexible and forward-thinking while keeping an eye on uncertainties in the global economy. So how they balance supporting economic growth while maintaining stability in the Indian external sector will be very crucial to shaping their decisions throughout FY 2026. Now that brings us to the end of the two stories of the day. Let's move on to the final section of the day, which is the quick news headlines. First, India's automobile retail sector saw a strong rebound in January 2025, with sales rising 6.6% year over year to 2.29 million units, up from 2.15 million units in January 2024. Now, this recovery was even sharper compared to December 2024, with a 30% surge in sales. Passenger vehicles led the way here, posting a 15.53% year-over-year growth and an impressive 58.77% jump from the previous month. Two-wheelers showed a 4% increase, while three-wheelers and tractors recorded a growth of 6.8% and 5% respectively. Commercial vehicles also saw an 8% uptick compared to last year. Second, IDC Limited reported a 1.18% rise in standalone net profit for the third quarter of FY 2025, reaching 5,638.25 crore rupees. This surpassed analyst estimates of 5,200 crore rupees. Revenue from operations grew by 8.4% year-on-year to 18,290.24 crores, up from 16,864.34 crores. Third, Bharti Airtel reported a dramatic surge in Q3 profits, jumping 483% year over year to 14,760 crore rupees from 2,530 crore rupees. Now, this increase was largely driven by a 14,322.5 crore rupee gain from consolidating Indus Towers as a subsidiary. But even if you exclude this one-time gain, their profits more than doubled, rising from 121.3% year-on-year to 5,514 crore rupees. That's all the news and stories I have for you today. I hope you enjoyed this episode and maybe learned something new from it today. This is your host Anurag Bansal signing off. I'll see you in the next episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.